Well, we expect 20 basis points of deeper rate cuts. We also expect the ECB to announce some degree of tiering of the deposit base, which will enable further rate cuts in the future. We also expect Mr. Draghi to extend the timeline for QE from September of this year to September of next year. So essentially lengthening of the QE period, and also expand the purchases that are part of that monthly purchase program by 10 billion euros. So I guess we're expecting a lot, but so is the market. The market is somewhat priced for 20 basis points of rate cuts, perhaps not so priced for an expansion of the LTRO program or the expansion of the asset purchase program. So we actually suspect there may be more upside for risky assets, because at least those things that we expect the market is at least not pricing in right now.
What are the chances that Mr. Draghi won't deliver on all those measures that you just outlined? If he doesn't, then we could see quite a vicious short squeeze on the single currency, yeah?
Yes. If you kind of look at how euro has been trading, it's broadly in the middle of its 105, 115 trading range. And to be very honest, at this point, while we're sitting in the middle, even with the ECB view that we have, it's difficult to say that, euro will go down. We are basically in the middle of the range, and the next leg of how the euro performs is going to be up to how the ECB actually delivers on these expectations.
The flip side, if there is material easing, if he ticks all those boxes that you just outlined there, could we see a move down to 106?
Perhaps by next week, but then by next week we'll be looking at the FOMC.
Exactly.
And again, we're not expecting the FOMC to hike interest rates this month. But it's not just that. Really, the issue is how the Fed...
Can I just ask you that?
Sure.
Ask you about the FOMC. The data's improved. Market sentiment is still fragile. I agree with you. I think they will hold off next week. But June, is that a likelihood where we could see 25 basis point hike?
Sure. I think that's the key point in terms of how the forward guidance of the Federal Reserve evolves. Specifically, how do the dot plots essentially which the Fed governors provide, whether that outlook changes. What our view is that essentially the Fed, if it hikes, it will essentially push markets once again into turmoil, once again limiting the Fed's ability to hike. So we are in this feedback loop between risky assets and the Federal Reserve's outlook. And to be very honest, we haven't seen anything that breaks this context altogether. So we actually think if the Fed gives a very hawkish testimony or basically maintains the dot plot, even if it doesn't hike in March, the market will build in expectations of a June hike, and then risky assets will collapse, and then we'll have this whole circle all the way back again.